Right now, across this country, there are flight schools that look completely fine from the outside. Busy front desks, airplanes on the ramp, websites with Enroll Now buttons, and smiling students in headsets. Some of them are running Discovery flight specials. Some of them just signed a lease on a third simulator bay. Some of them expanded their fleet 18 months ago because the pilot shortage narrative was everywhere, and it genuinely looked, like the demand was only going one direction. A lot of those schools are not going to be open in 18 months. Not because aviation is dying, not because people stopped wanting to fly, not because the pilot shortage stopped being real, but because a set of financial, regulatory, demographic, and structural pressures that have been building quietly underneath the surface of general aviation flight training for the better part of a decade have now converged in a way that is going to compress the flight school landscape faster and harder than almost anyone in the industry is publicly acknowledging. The schools that understand exactly what's happening and why, the ones that can see the specific mechanisms driving this, are the ones with a real shot at navigating through it. The ones that are still operating on the assumptions that made sense in 2021 are the ones that will be posting closure notices on their Facebook pages and leaving students stranded mid-certificate. Today I'm walking you through the full picture of why this bubble is bursting, what specifically is causing it, which types of schools are most exposed, and what it actually means for students, instructors, and the broader general aviation ecosystem when this shakeout runs its course, because it is going to run its course, and understanding the shape of it matters enormously if you have any stake in this industry at all. Before we get into it, hit subscribe, because the financial mechanics of general aviation, the parts that actually explain why things are happening underneath the marketing and the press releases and the airshow enthusiasm, are exactly what I cover here, and this is one of the most consequential stories in GA right now. You want to be following this one closely, because the implications run a lot further than just flight schools. Let's start with how we got here, because you cannot understand why the bubble is bursting without understanding how it inflated in the first place. Between roughly 2018 and 2023, flight training got bathed in a narrative that was genuinely compelling and largely accurate on its surface. The pilot shortage at the regional airline level was real. It was documented, it was covered in mainstream business press, and it created a sense among aspiring pilots and the schools recruiting them that flight training was a near-guaranteed pathway to a well-paying professional career. The airlines were hiring aggressively. Regional carriers were signing students to cadet agreements while they were still working on their private certificates. The number of hours required to get a first officer seat at a regional airline, the ATP minimums, had been raised to 1,500 hours after Colgan Air, and that meant a pipeline that needed to stay full constantly to keep up with demand at the top. Every pilot who left training and moved up through the system had to be replaced by somebody new, and the schools supplying that pipeline could not stay empty. Flight school enrollment surged. New schools opened. Existing schools expanded aggressively, taking on more aircraft, hiring more instructors, leasing bigger facilities, adding simulators. Private equity started noticing that flight training could be packaged, franchised, and scaled in ways that aligned with how investors think about managed service businesses with recurring revenue. A wave of consolidation and VC-backed expansion entered a space that had historically been dominated by small operators running 5 airplanes out of an FBO that also sold 100 LL. The influx of capital allowed some of these consolidated school networks to grow extremely fast, which looked, from the outside, like the industry maturing and professionalizing. Meanwhile, the student pipeline was also being fed by a second story running parallel to the airline shortage narrative. The pandemic had a genuinely strange effect on flight training enrollment. A portion of grounded professionals, people who suddenly had time and found themselves reconsidering what they actually wanted to do with their lives, discovered flying for the first time or came back to it after years away. Recreational interest in aviation spiked. Waiting lists at training-focused schools got long. Simulator time was booked out weeks in advance. The whole training ecosystem felt like it was operating at capacity, which, for a while, it genuinely was. The schools that expanded during this window made decisions based on a forward projection that assumed the conditions driving that demand were durable: more capacity, more aircraft, more instructors, more debt to finance all of it, secured against an assumed future revenue stream that looked rock solid, given everything the market was signaling at the time. That is exactly the anatomy of a bubble. Not irresponsibility in most cases, but rational decisions made under conditions that turned out not to be permanent, by operators who didn't see what was about to shift. Here is what started shifting. and it shifted in several directions at once, which is why the effect is as severe as it is. The first shift, and in some ways the foundational one, is what happened to the cost of actually completing a training program. The total cost of getting a student from zero to a private pilot certificate has increased significantly over the last 4 to 5 years, and it has not increased a little. We are talking about cost structures that have moved in ways that have materially changed who can realistically complete training and how long it takes them to do it. Aircraft operating costs drove a large part of this. Avgas prices moved up sharply and have stayed elevated. Engine overhaul costs went up because of parts availability issues, labor cost increases at engine shops, and the general inflation in anything that requires skilled technical work. Airframe maintenance costs followed the same pattern. Liability insurance for flight schools, the coverage on the training aircraft and on the operation itself, moved up meaningfully, and for some smaller operations it moved up dramatically, because underwriters tightened across the entire GA space, and training operations carry a risk profile that kept getting more expensive to cover. Every one of these costs gets passed to students through higher hourly rates, and the cumulative effect on the total cost of a private certificate has been significant. A private pilot certificate that realistically cost a student somewhere in the range of $10,000 to $12,000 to complete 5 or 6 years ago is now, at a typical school, realistically in the range of $15,000 to $18,000 to complete, sometimes more depending on the market, the airplane type, and how efficiently the student can schedule training around the school's availability and instructor consistency. That is not a small change. For a large portion of the population that was considering flight training as either a recreational pursuit or a professional pathway, that cost increase is the difference between a difficult but achievable financial commitment and something that simply doesn't pencil out given their actual life situation. The cost increase hits the professional pathway student especially hard because the total exposure is not just the private certificate, it's the entire pathway to commercial and instrument ratings and the building of 1,500 hours. When you run the math on the complete training pathway from 0 to ATP minimums, the total cost at current pricing is genuinely staggering compared to where it was even 5 years ago. Schools that built their enrollment projections on a student throughput model tied to pilot shortage-driven demand are discovering that the cost of the pathway they're selling has moved faster than their average student's ability or willingness to finance it. The second shift is on the financing side, and this connects directly to everything happening in the broader interest rate environment. Flight training loans are almost universally unsecured consumer debt, meaning they carry rates that respond directly to the overall rate environment in a way that a home mortgage might not, because there's no collateral backing the loan. The rate environment of the last 2 years has made flight training financing meaningfully more expensive for students who are borrowing to get through their ratings, which is a very large portion of the student population that schools are competing for. When the monthly payment on a flight training loan goes up because rates moved, some students who were on the fence about whether training was affordable decide it isn't. Some students who started training and are partway through run out of comfortable borrowing capacity before they finish, and the dropout rate at the mid-training stage goes up. That dropout rate is actually one of the dirtiest secrets in flight training economics, and it's worth spending a real moment on because it shapes how these businesses actually work financially. A large percentage of students who start toward a private pilot certificate do not finish. Before the current pressures, that dropout rate was already high. Cost increases and financing headwinds have pushed it higher. For a flight school, a student who drops out after 40 or 50 hours has consumed significant instructor time, aircraft operating expense, and administrative overhead. They've paid for the hours they flew, so it's not a total loss, but they don't become the ongoing customer that the school's business model depends on. They don't complete the instrument and commercial ratings that generate the higher margin hours deeper in the program, and they don't become the word-of-mouth referral engine that a successful graduate represents. A rising dropout rate at the early and mid-training stages is not just a human cost, it is a direct hit to the revenue projection that justified the school's current capacity and overhead structure. The third shift is what happened at the top of the pipeline that was supposedly justifying all of this expansion. The airline hiring environment has cooled from its absolute peak, not collapsed, not disappeared, but moderated in a way that has materially changed the career math for a student starting from scratch today versus a student who started 4 years ago. Some regional carriers that were hiring aggressively have slowed down. The aggressive cadet agreement programs that were signing students early in their training have pulled back or gotten more selective. The starting pay at regional first officer level has improved over the last several years, which is a genuine positive, but the time horizon to meaningful income for someone starting from zero is long enough and expensive enough that the career pathway calculation has gotten harder to make work, particularly against the backdrop of a cost of training that has moved significantly upward at the same time. The student who was told 4 years ago that a flight training investment of $60,000 or $70,000 was the on-ramp to a career paying $150,000 at a major airline within 8 to 10 years was making a calculation that a lot of people could get comfortable with. The student looking at that same pathway today, against a training cost that has moved upward, against a hiring environment that is less uniformly aggressive than it was at peak, against an interest rate on their training loans that has moved up, is making a harder calculation, and a meaningful number of them are deciding to pursue it less aggressively, pursue it differently, or not pursue it at all. That changes the enrollment pipeline for the schools that built their capacity around the assumption of a sustained surge in professional pathway students. The fourth shift is structural, and in some ways it is the most damaging for the specific cohort of schools that expanded most aggressively during the boom. The expansion years produced a wave of new capacity entering the market, new schools, expanded existing schools, consolidated school networks building out footprints in markets they hadn't served before. That capacity got built against demand projections that assumed the boom conditions were going to last, and in a lot of regional markets, the result was a meaningful supply overhang, more available training slots, more aircraft, more instructor hours available than the actual student demand in that market could fill. When demand was at peak, the overhang was invisible because everything was full anyway. As demand has come off from peak, the overhang is becoming painfully visible. A flight school running a fleet of 10 airplanes at full utilization, say 700 hours per airplane per year, generates very different economics than that same fleet at 50 or 60% utilization. The fixed costs don't move, the hangar lease is the same, the insurance is the same, the aircraft financing payments are the same, the maintenance reserves are the same, the front desk staff is the same. Revenue drops proportionally to utilization. Below a certain utilization threshold, the operation goes from generating working capital to consuming it, and a school that expanded its fleet with debt during the boom years is consuming working capital on every aircraft that isn't flying enough hours to cover its fully loaded cost. Let's talk about the aircraft financing piece specifically, because this is where a lot of schools that expanded aggressively are discovering the most acute pain, and it's a mechanism that doesn't get discussed enough when people talk about why flight schools close. Training aircraft are expensive. A new Cessna 172, which is effectively the standard training aircraft for most of GA flight training, is now selling for prices that would have seemed completely disconnected from reality even 10 years ago. We are talking about a fully equipped training configuration in the range of $500,000 at current pricing, sometimes more, depending on avionics and configuration. A school that bought a fleet of 10 new airplanes 2 or 3 years ago, financed over 7 to 10 years, is carrying debt service obligations that are meaningful against whatever utilization their current student enrollment is generating. The math on this is worth actually walking through, because the gap between the assumptions baked into the original financing and current reality is where the crisis lives. A school that acquired a training aircraft at $450,000, financed at the rates that prevailed during the boom years, carrying that monthly payment against projected utilization of 700 or 800 hours per year, built a business model that depended on a specific revenue per hour and a specific number of hours flown. When utilization drops because student enrollment has come off, because the cost of training has pushed some students out of the market, because the regional market got oversupplied with training capacity, the revenue drops but the debt service doesn't. The school doesn't get a forbearance on its aircraft financing because enrollment is soft. The payment is due every month, regardless of how many hours that airplane flew. There are schools sitting in exactly this position right now, carrying aircraft debt that was sized for peak utilization against actual utilization that has come meaningfully off peak, running through their working capital reserves, burning through the equity that was built up during the boom years, and reaching a point where the math simply doesn't recover on its own. The only options at that stage are a capital infusion from ownership, a restructuring of the debt, a fleet reduction that accepts the loss on whatever the assets are worth in the current used training aircraft market, or closure. The used training aircraft market is its own painful part of this story. Schools looking to shed fleet capacity are discovering that a lot of other schools are trying to do exactly the same thing at the same time, which means the market for used training aircraft is carrying more supply than it was during the years when any flyable 172 had a buyer waiting for it. Prices have softened from peak, which means a school trying to sell an airplane it financed at near peak pricing is looking at a gap between what it owes on the aircraft and what it can actually sell it for, a negative equity position that has to be absorbed out of operating reserves if the school wants to right-size its fleet. For schools that are already cash constrained, that negative equity hit is sometimes enough to push them over the edge. The fifth shift, and this one is subtler but genuinely important, is what's happened in the instructor market, which sits at the exact center of how flight training businesses actually operate day to day. Flight schools are, fundamentally, instructor-dependent businesses. An airplane doesn't generate training revenue on its own. A simulator doesn't run itself. The product that a flight school sells is instructor time, bundled with aircraft time, and the quality, availability, consistency, and retention of the instructor staff determines whether students complete their training efficiently and whether the school can run its scheduling at the utilization rate the business model requires. The traditional economic model of the flight school instructor is one of the most genuinely strange financial arrangements in any professional service industry. Career path pilots building hours toward their airline minimums have historically worked as flight instructors for wages that were, by any reasonable comparison to other professional services roles, extremely low, because the value they were extracting from the role was not primarily the salary, but the flight time logged toward their own career goals. A first-year flight instructor at many schools was making somewhere between $30,000 and $50,000 a year while working a schedule that would have exhausted most people in a comparable service role, and the implicit bargain was that the school got skilled instructional labor at below-market wages and the instructor got paid in hours toward their career goals. That model has been breaking down for several years, and the pressures on it have accelerated. Airline starting pay has improved meaningfully, which means the opportunity cost of spending 2 years building hours as a flight instructor got more expensive. The demand for CFIs at the airline level and at the corporate and charter level pulled experienced instructors out of the school environment faster than schools could develop replacements. Schools started having to compete for instructors in a way they hadn't had to in the past, which means wages moved up. Benefits got added, and the fully loaded labor cost per instructor hour went up at many operations. Meanwhile, the student load per instructor, the utilization of instructional time against available capacity, is subject to exactly the same enrollment variability as the aircraft utilization discussion we just had. An instructor who is flying 6 to 8 hours of instruction per day when the schedule is full is generating very different revenue for the school than an instructor flying 3 or 4 hours per day when enrollment is soft. The school is carrying the fixed cost of that instructor either way, whether through salary or through minimum hours guarantees that are now common enough in instructor contracts to prevent good people from walking to a competitor. The combination of higher instructor wages and lower utilization due to enrollment softening is a direct margin compression at the core of the flight school P&L, and it's showing up in financial results at schools across the industry right now. Schools that built their staffing models on the assumption that both utilization and wages would stay where they were during the boom years are discovering the gap between those assumptions and current reality in the most visceral way, which is that they're running out of the cash cushion that was supposed to absorb normal operational variance. The sixth pressure, and this one is specific to the schools that were caught up in the private equity and institutional investment wave of the expansion years, is the capital structure problem, and it's worth unpacking carefully because it's different in character from the organic operator's financial pressures. When private equity or institutional capital enters a service business, it typically does so with a specific thesis about growth, margin expansion, and exit. The thesis that drove PE interest in flight training was something like, this is a fragmented market with durable demand driven by structural pilot shortage dynamics. There are real economies of scale available through consolidation and standardized operations, and an aggregated school network with professional management and technology infrastructure can capture those economies and exit at a multiple that justifies the capital committed. That's a coherent thesis on its face, and the conditions of 2019 through 2022 made it look like the timing was right. The problem is that the thesis depended on the demand being both durable and price inelastic enough that the cost structures a professional, institutionally backed operation carries, management fees, technology costs, overhead at the network level, debt service on the acquisition financing, could be supported by student revenue growing consistently over the investment horizon. When demand proved more elastic to price and more sensitive to the broader economic environment than the thesis assumed, the capital structure of these expanded operations became a problem. A PE-backed flight school network carrying acquisition debt, management overhead, and a cost structure sized for growth is in a fundamentally different financial position than a small organic operator who owns their aircraft outright and runs lean on overhead. When revenue comes off, the lean organic operator has real pain, but operational flexibility. The institutionally backed network has covenants, reporting requirements, capital structures that require revenue to service the debt, and investors expecting an exit that is getting further away, not closer, as market conditions soften. Some of these networks are now actively trying to figure out what restructuring looks like, which schools in their portfolio can be made viable at a reduced cost structure, and which ones need to be wound down or sold to a buyer who can operate them without the institutional overhead. That process is actively underway at several major consolidated training operations right now, and its conclusion is going to remove meaningful training capacity from the market in specific regional footprints where those networks are concentrated. The seventh pressure, and arguably the one that is least discussed in industry publications because it's uncomfortable to talk about openly, is the quality and completion rate problem that the expansion years created in a very specific way. When schools were growing fast and desperately needed instructors to fill the expansion, the market for CFIs got tight enough that some schools brought on instructors who were technically qualified, meaning they held the certificate, but who were not experienced or skilled enough as instructors to efficiently move students through training. A flight instructor's certificate is not a guarantee of teaching ability. It's an aviation certificate with a practical test standard that tests aeronautical knowledge and some instructional technique. But the actual skill of efficiently and effectively teaching someone to fly, in a way that keeps the student progressing and motivated and not running up hours without moving toward check ride readiness, varies enormously from instructor to instructor. During the boom years, some schools didn't have the luxury of being selective about this because there simply weren't enough experienced CFIs available. The downstream effect of putting students with less effective instructors is that student progress slows. The hour count required to reach check ride readiness goes up. The total cost to the student climbs, the frustration level builds, and the dropout rate rises. A student who expected to reach private check ride readiness at 50 to 60 hours and is at 80 hours and still not there, having spent $10,000 to $12,000 more than they planned, is a student who is much more likely to stop training than a student who is progressing efficiently under a skilled instructor. That dropout hits the school's revenue projection, creates a spot in the training queue that may or may not be refilled by a new enrollment, and generates a word-of-mouth reputation in the local market that makes future enrollment acquisition harder and more expensive. Several schools that expanded fast are now dealing with a reputation deficit in their local markets that is actively hurting new enrollment in a way that compounds everything else going wrong financially. The students who dropped out, who talked to their networks about why they dropped out, who left negative reviews on the places potential students looked before enrolling, have created headwinds that require real investment in quality improvement, instructor development, and marketing to overcome, and those investments are competing for the same working capital that's already under pressure from all the other forces we've discussed. The eighth pressure is geographic and demographic, and it's about who is actually available to become a student in the specific market a school serves, rather than the national narrative about pilot demand. This distinction matters a lot more than most people in the industry talk about publicly. The national pilot shortage story is aggregate. It's about the total supply of ATP-qualified pilots relative to the total demand across all carriers and all operations. The local flight school story is about whether there are enough people with enough disposable income or access to financing within a reasonable commute of that school's physical location who are at a life stage where starting flight training makes sense to fill that school's schedule. Those are very different questions, and the answer to the national aggregate question is not automatically the right answer to the local market question. A school in a mid-sized metro area with a declining median household income, an aging population that has already largely been captured or aged out of flying, and a young professional demographic that is carrying significant student loan debt and housing cost pressure is operating in a very different enrollment environment than a school in a growing metro area with strong household income formation and a large professional population that has both the means and the life stage curiosity to consider flight training. During the boom years, the national narrative lifted all boats enough that many schools in genuinely challenging local demographic markets were doing fine because the enthusiasm and the airline career story were generating inquiries nationally, bringing in students from outside the immediate catchment area and keeping the scheduling full enough to cover the cost structure. As that national enthusiasm has normalized and the pipeline has become more competitive, schools in difficult local demographic markets are discovering that the underlying pool of genuinely qualified, financially viable, locally accessible students was always smaller than the boom years enrollment numbers suggested. And building a business around a temporary surge in national enthusiasm does not change the structural reality of the local market. The schools that are going to weather this most effectively are, almost without exception, the ones serving markets where the underlying demographics actually support flight training at the scale they've built for, and the ones that get most exposed are the ones that built for a demand level that was partly structural and partly a temporary narrative effect that has now faded. Let me shift to talking about what the closure wave actually looks like in practice, because it's not going to be uniform, it's not going to be announced in advance, and the way it unfolds has very specific implications for students who are mid-training and for the instructors who work at these schools. Most flight school closures do not look like a clean, announced shutdown with adequate notice for students to transfer records and complete training elsewhere. They look like a gradual deterioration. An airplane goes into maintenance and doesn't come out because the school doesn't have the cash to pay the shop. The CFI with the most students gets a better offer somewhere else and leaves, taking their scheduling momentum with them. The simulator books get lighter because students stop scheduling as word gets around that the school is struggling. The discovery flight marketing that used to run consistently goes quiet because the marketing budget got cut. The front desk starts taking longer to return calls. The owner stops coming in every day. By the time a school in this trajectory actually posts a closure notice, the active student population has often already been declining for months. Some of the most experienced staff have already moved on, and the remaining students are often partway through ratings with logbook entries they need, and records that may or may not be properly organized and accessible after closure. The FAA has processes for dealing with flight school closures, and students' logbooks are their own legal property, but the practical disruption of having a school close mid-training, potentially with outstanding balances on account that are very difficult to recover, is a genuine harm that falls on students who had no warning and no role in the financial decisions that put the school in that position. The instructor picture in a closure wave is also worth understanding clearly. A CFI who has been building hours at a school that closes has their time, their certificates, and their logbook. Those don't disappear. But they may be midstream on relationships with students who now need to find a new school, and the disruption to their own hour-building progress and their professional trajectory is real. The best-positioned instructors in this environment are the ones who have built enough reputation and relationships in their local market that they can move to a surviving operation, or go independent under Part 61, without losing momentum. The instructors at greatest risk are the newer ones, who were brought on by schools that expanded aggressively, and who are now caught in a structural contraction at the worst possible time for their own career timelines. Now let's talk about which specific categories of schools are most exposed, because the risk is not spread evenly across the industry, and understanding where the highest concentration of closures is going to come from matters if you're trying to assess whether your school, or a school you're considering enrolling in, is in the danger zone. The highest risk category is large Part 141 schools that expanded fleet and facility size aggressively between 2020 and 2023, financed primarily through debt, targeting primarily the professional pilot pathway market. These schools made rational decisions in a specific market environment, but the combination of high fixed costs, enrollment sensitivity to the professional pathway narrative, debt service obligations sized for peak utilization, and instructor labor costs that moved up during the expansion are all converging on a financial model that doesn't work below a specific revenue threshold, and too many of them are operating below that threshold right now. When a school in this category runs through its liquidity reserves, the decision tree narrows very fast, and closure becomes the most likely outcome, unless a strategic buyer emerges who wants the infrastructure at distressed pricing. The second highest risk category is the schools that entered the market specifically because of the boom-era narrative, started operations in the last 3 or 4 years, and have not yet built the local reputation, the student referral network, or the instructor depth that provides any cushion against a softening market. New entrants during a boom always carry elevated survival risk when the cycle turns, and flight training is no exception. A school that opened in 2021 based on a market that looked completely different than the market of 2025 is essentially being asked to compete for a declining share of a more difficult enrollment environment using infrastructure it acquired at peak pricing. without the established reputation that routes new students to the longer operating schools in the same market. The survival rate for this cohort is going to be low. The third high-risk category is schools that became overly dependent on a single corporate, military, or institutional contract for a disproportionate share of their revenue. This could be a school that built its capacity around a pipeline agreement with a regional airline, a school that was running cadet programs for a carrier that has since reduced or eliminated that program, or a school that was heavily dependent on international student enrollment through a specific visa program that has gotten harder to administer. Concentration risk in flight training is as dangerous as in any other service business, and the schools that built their fixed cost structures around a large institutional contract that has now been reduced or eliminated are in acute financial distress, even if their general enrollment business is basically fine. The fourth risk category is harder to see from the outside, which is the owner-operated small school that looks stable because it's been around for a long time, has low visibility overhead, and presents as a normal functioning business, but is actually being kept alive by the owner absorbing losses, deferring their own compensation, not replacing aging aircraft, and gradually depleting the equity they built up during the good years. These schools don't look like they're in trouble until the day they close, because the owner's personal financial commitment is masking the structural reality of the business. When the owner reaches the point where they can no longer absorb further losses, or when a critical piece of equipment fails and there isn't cash to fix it, the closure happens quickly and with very little warning to students or staff. Let's spend time on the structural forces that go beyond the current cycle, because some of what's driving this is not just about the interest rate environment and the normalization of post-pandemic enthusiasm. Some of it is genuinely structural, meaning it doesn't reverse when conditions normalize, and understanding the structural components is essential for thinking about what the flight training landscape looks like on the other side of this shakeout. The cost of regulatory compliance for flight schools has been on a steady upward trajectory for years, and it shows no signs of reversing. Part 141 approval requires maintaining an operations manual, a curriculum, ground school facilities, a stage check process, and compliance with FAA oversight that consumes real administrative and management time. The burden of that compliance is relatively fixed regardless of school size, which means it falls proportionally harder on smaller operators. The administrative infrastructure required to run a properly compliant Part 141 operation today is meaningfully more burdensome than it was 15 years ago. And for a small operator running 5 or 6 airplanes, the cost of maintaining that compliance is a real drag on the economics of the business that larger operations can spread across more revenue. Liability exposure is another structural cost that has moved in one direction consistently. The cost of insuring a flight training operation against the full range of potential claims, student injury, aircraft accidents, third-party property damage, has climbed as GA accident rates, while historically quite low in absolute terms, have attracted underwriter attention in a way that has tightened availability and raised pricing for operators at the smaller end of the market particularly. When a flight school is already running on thin margins, an insurance cost increase of 10 or 15% is a direct hit to whatever operating margin existed, and for schools already below break-even, that hit is not survivable without additional capital. The physical plant of flight training, meaning the airport infrastructure itself, is another structural pressure that doesn't get enough attention. Many general aviation airports that serve as the base of operations for smaller flight schools are themselves facing financial and infrastructure pressures, aging facilities, deferred maintenance, land use conflicts with surrounding communities, and airport authority decisions about land leases and facility access that can significantly impact the economics of schools operating there. A school that loses a favorable hangar lease, that faces a meaningful increase in tie-down or hangar rent, or that finds itself on an airport where the runway has been closed for extended maintenance, or where the airport authority is considering operational changes, is dealing with a structural cost pressure that has nothing to do with enrollment trends and that can materially change the business case for operating at that location. The fuel infrastructure story, which we've talked about extensively in other contexts, matters for flight schools in a specific way. The transition away from leaded avgas is a real and ongoing regulatory process, and while unleaded alternatives have cleared approval for the training aircraft fleet, the timeline and cost of transitioning the physical fuel infrastructure at airports, particularly smaller general aviation airports where the economics of upgrading fuel storage are challenging, introduces operational uncertainty for schools that depend on a specific fuel type being consistently and affordably available at their home airport. Schools that operate at airports where the fuel transition is likely to be slow or expensive to execute are carrying a long-term infrastructure risk that more favorably situated schools don't face. Let me talk about what happens to the students, because that is ultimately the most important human dimension of this story, and it deserves real attention rather than being treated as a footnote to the business analysis. Students who are mid-training when a school closes face a specific set of challenges that the formal regulatory framework partially addresses and partially doesn't. Their logbook entries are valid and their own property. Their medical certificates and any certificates they've already earned remain valid. If they were enrolled in a Part 141 school with an approved curriculum, their stage check endorsements and completed stages may be transferable to another Part 141 school under specific conditions, though not automatically and not without the receiving school's cooperation. Their ground school records, if properly maintained and accessible after closure, are useful documentation for continuing training elsewhere. What the framework does not address is the financial dimension. Prepaid balances on student accounts at a closed flight school are typically handled under the general rules of business insolvency, meaning unsecured creditors, which is what a student with a prepaid balance is, get whatever the liquidation produces after secured creditors are satisfied, which in a flight school insolvency is typically very little. Students who have prepaid accounts, whether through a lump sum payment at enrollment, through a flight training loan that was disbursed to the school in advance, or through any other arrangement where money went to the school before training was completed, are in a genuinely bad position when closure happens, and recovering those funds through normal legal channels is difficult and often not worth the cost relative to the amount at stake. The lesson for students in the current environment is clear and worth stating directly. Minimize prepaid balances. Pay close to as you go, rather than in large advance lump sums, whenever the school offers that option. Ask your school to show you their aircraft financing arrangements and give you a genuine sense of their financial health before you hand over a significant sum of money. Understand that a school that is aggressively offering enrollment discounts or package pricing that requires large upfront payment may be doing so because it needs the cash, not because it's being generous, and consider what that implies. None of this is pleasant to think about when you're excited about learning to fly, but it's real. And the students who are going to get hurt the most in the next 18 months are the ones who had no awareness of these risks. For instructors, the message is parallel in structure. Build relationships with students that are genuinely yours, not just the school's. Maintain your own professional reputation in the local market in a way that survives any single employer. Keep your own records, your own endorsement logs, your own documentation, in a way that is accessible and organized, regardless of what happens to whatever school you're currently employed by. The instructors who navigate this transition smoothly are the ones who treated their own professional standing as an asset separate from the institution they happen to be working at, and the ones who built everything into the school's system rather than maintaining their own independent professional identity are the ones who lose the most if the school goes away. Now let's look at the flip side of this, because a shakeout of this scale, while genuinely painful for the operators and students caught in it, is not uniformly bad for the health of the flight training industry. Some of what's getting compressed is capacity that genuinely shouldn't exist at its current cost structure and quality level. Some of the schools that will close are schools that were not serving students well, that were producing dropout rates and completion numbers that were bad for students and bad for the pipeline, and whose departure from the market actually makes space for better operations to grow. The schools that are going to come out of this stronger are, consistently, the schools that made quality the central organizing principle of their business rather than volume. The schools that invested in instructor development and retention, even when it cost more than the market minimum to do it. The schools that kept fleet quality high and aircraft downtime manageable, even when deferring maintenance, would have been easier for the short-term cash flow. The schools that built relationships with their students that created completion rates meaningfully above the industry average, because a student who completes their training is not just a completed program, they're a potential instrument student, a potential commercial student, a potential renter for the rest of their flying life, and a referral source that generates new enrollment without marketing cost. The economics of a flight school that consistently completes students at a high rate are fundamentally different from the economics of a school with a high dropout rate, even if the hourly rates and fleet size look similar on paper. High completion means high utilization deep in the training program, where the complex airplane hours and the instrument hours and the cross-country hours generate revenue at a per-hour rate that's often higher than the basic early training hours. High completion means the referral network keeps growing, rather than being neutralized by the word of mouth from students who dropped out frustrated and feeling like they wasted money. High completion means a roster of certificated pilots who are customers for aircraft rental, for recurrent training, for check ride prep, and for all the ongoing aviation services that complement the initial training business. Those schools, the ones that were always fundamentally about the quality of the training rather than the volume of the enrollment, have a genuine competitive advantage in the market that's emerging from this shakeout. They were not the schools most likely to have expanded recklessly during the boom. They were not the schools most likely to have taken on the debt loads that are now unpayable at current utilization. They are the schools most likely to still be standing when this compression runs its course, and in many markets, they are going to find themselves serving more students than they had before because the capacity that surrounded them has left. The technology picture is worth a brief look too, because one of the genuine positive developments that's happening in parallel with the financial pain is a set of technological tools that are genuinely improving the efficiency of training, and the schools that adopt them intelligently have a real advantage going into the new landscape. Simulator technology has improved enough that modern flight training devices and advanced aviation training devices can carry meaningful instructional value at a fraction of the aircraft operating cost, and integrating simulator-based training more intelligently into the curriculum is one of the clearest paths to reducing the total cost of training completion without reducing training quality. The schools that are using their sim infrastructure effectively, not just as an hour logger, but as a genuine teaching tool for the instrument procedures and the systems knowledge and the emergency scenario practice that are actually better taught in a simulator than in the airplane, are reducing their total cost per completion in a way that makes them more competitive on price while maintaining margins. Digital scheduling and student management tools have also matured enough that operational efficiency in a well-run school can be meaningfully better than it was 5 years ago, reducing the overhead cost per student and freeing instructor time for actual teaching, rather than administrative tasks. The schools that made those technology investments intelligently are carrying lower administrative overhead per student served, which matters a lot when margins are thin. The regulatory picture is worth a moment of honest assessment too, because some of what's coming in the regulatory space could either help or hurt the training industry, depending on how it develops. The ongoing evolution of the Sport Pilot and Sport Pilot Light Sport aircraft framework under Mosaic has implications for flight training in ways that are still being worked out. If a broader population of aircraft becomes eligible for Sport Pilot training, and if the simplified maintenance requirements that come with some of that framework reduce operating costs for training aircraft in that category, there's a potential path to lower cost training on appropriate aircraft for students whose flying goals are within the recreational or private category, rather than the professional pathway. That would be genuinely good for broadening access to the entry point of flight training, though it doesn't solve the pipeline problem for the professional pathway schools.